Hello friends, a very warm welcome to my channel. In today's video, we are going to decode and analyze the business of Endurance Technologies. Endurance is one of the market leaders in the two-wheelers and three-wheelers auto components industry and one of the major players in the four-wheelers space as well. So if you're new to the channel, please do subscribe and hit the bell icon. And if you're not a part of our Telegram channel, do join right now because we share a lot of interesting views, news and analysis on our Telegram channel as well. Let's get started. So Endurance Technologies is an auto ancillary company. It is a company which makes auto components for OEMs. OEMs, will be using this term a lot of times in today's video. It's original equipment manufacturers. So brands like Maruti, Tata, Bajaj, TVS. So all these companies are called OEMs. For them, these companies which are Endurance Technologies, they make components. So these components are assembled by these OEMs and sold as an end product in the form of a vehicle to the end customers. So they make auto ancillaries which are mainly categorized into four parts, which are aluminum die castings, suspensions products, transmission products which moves the vehicle, and braking systems. So these are the four categories in which these products are manufactured by Endurance Technologies. When it comes to aluminum die castings, this is the largest manufacturer in India, and in other spaces as well. They are among the top two in all the products which they manufacture. They have 27 strategically located manufacturing units which are located near the OEMs. So why is it important that the manufacturing facility is located near the OEM? Because the coordination with the end customer is easy. In lot of auto ancillary companies, you might have observed that they set up small manufacturing units. So they don't have a very large manufacturing unit. They set up small manufacturing units which are near to their main customers. So that eases their communication and coordination with the end customer, and the transportation cost and the other operational costs are also reduced. So this brings in more efficiency and accuracy. So that's why the manufacturing units are strategically located near the OEMs. So this company has manufacturing units in 3 countries and exports to more than 28 countries across the globe. So the other companies might be having manufacturing units in India and supplying across the globe, but here it is slightly different. They have manufacturing in 3 countries. They have manufacturing units in Europe as well. So let's understand briefly the history and milestones the company has achieved in its history until now. In 1985, they started their business of aluminum die castings business. And in 1996, they entered into the two-wheeler suspension business. So they ventured into the second category of business, which is related to suspensions. In 1998, they entered into the two and three-wheelers transmission business. Now they have entered into the third category of business. In 2001, they started aftermarket sales. Now what are aftermarket sales? There are 2 ways in which they can sell their auto components. The first one is they sell to the OEM who assemble those auto components into complete vehicles and sell to the end customers. The second way is that after the vehicle is sold, if the vehicle comes for repair, the auto components have to be replaced. So they sell those to their distributors and dealers, and they in turn sell to their end customers or replace those parts in the vehicles of their end customers. So that is called aftermarket sales. In 2004, they entered into the two-wheeler disc brake business. Now they have entered into another segment which is related to the braking systems. And in 2006 and 2007, they did inorganic acquisitions of businesses in Germany and Italy. So they ventured into their European territory. In 2016, they started a new manufacturing unit in Gujarat. In 2018, they started another manufacturing unit in Halol, Gujarat. And in 2019, they started a new manufacturing unit in Karnataka. Apart from this, there were several other small manufacturing units started, and there were several other small acquisitions done during their journey. We are highlighting only the important ones. So you observe that the company has grown organically by their capex, as well as inorganically by acquiring companies in India as well as in Europe. In 2020, again, they acquired a 99% stake in an Italian company which is called Alderspa. So this way, the company has a very interesting history and quite a few milestones in its history along the way. Now let's talk about the management of the company. The chairman is a non-executive director, Mr. Soumendra Basu. He has more than 36 years of experience in the banking industry. The managing director is Mr. Anurag Jain. He is the promoter of the company, and he and his family owns almost 75% of the stake in the company. So it's a very good stake. And he has more than 31 years of experience in the auto ancillary industry. Now let's understand briefly how is the corporate structure of the Endurance Group. So Endurance Technologies Limited, the ETL, is the parent company. Under that, there are 2 wholly owned subsidiaries, one in Italy and another one in Germany. And further in Italy, there are further 5 wholly owned subsidiaries. So in Europe, they operate through their subsidiaries, and in India, they operate through their main company. So it's a very simple corporate structure, and most of the subsidiaries are wholly owned subsidiaries. Now let's talk about the business of the company. The India business, which comprises broadly of the two-wheelers components, the three-wheelers and the four-wheelers components. Now in two-wheelers components, there are 4 segments. the aluminum die casting business, then the suspension, transmission and the braking systems. In the aluminum die casting business, they manufacture products like alloy wheels, engine covers, crankcase, cylinder heads. In the suspension business, they manufacture products like front forks. In the transmission business, they manufacture products like clutches. And in the braking systems business, they manufacture products like the rotary disc, brake caliper assembly. So all these are technical details which we will not get into, but broadly you can understand that these are the 4 categories of products which they cater to in the two-wheeler segment. And the maximum of their revenue comes from the two-wheeler segment, which we will understand in the coming slide. In the three-wheelers, they manufacture these products like hydraulic shock absorbers, drum brakes, and in four-wheelers, they manufacture products like gearbox housing and conventional vehicle clutches. So these are the main products which they manufacture in their Indian manufacturing units. Now coming to their Europe business. In Europe business, they are mainly focused towards manufacturing products or auto components related to the four-wheelers. In four-wheelers, they are manufacturing parts like the suspension and the body parts and a few engine parts like cam carriers, exhaust manifolds. In the EV category, you need to understand that the more the vehicle is lighter, it gives more mileage. So there is a shift towards using aluminum die casting products instead of the other steel and the other metals which are heavier in weight. So this gives this company an advantage that their products will be used more compared to the other metallic products in future. So in EV, they manufacture transmission parts like transmission housing, then gearbox housing and torque converter housing. So this is a segment and the products which they manufacture in their Europe business. As a company, you need to understand that this company provides a end-to-end solution to the customer. When they come with a requirement, the company can design a product, they can develop a product as per their customers' requirements, they can test and validate the products, they can manufacture the product, deliver the product, and post that they can also give after-sales service. So in this way, they offer end-to-end solutions to their customers. This is not very common in all the auto ancillary space. A company which is able to work as per the requirements of the customers right from scratch gives them an additional advantage or edge over its competitors. Coming to the aftermarket sales, this is an area in which the company is focusing more, as the margins are more in this business, as it is a kind of indirectly B2C business. So as they focus more on this, you understand that from India they get about 72% of their business, Latin America 7%, Africa 8% and other Asian countries about 13%. Now this is a very interesting place which the company has built, which is called Endurance Proving Ground. They have made this in Aurangabad. So this is like a track where the company tests its products by using this track, and they also let the other OEMs use their track to test their vehicles. So this, as you see in the picture, it looks like a very interesting place, and this is quite rare that some company builds this kind of a facility for themselves and for their customers. As per the vehicle type, if you try to understand, maximum close to 60% of the revenue comes from the two-wheeler segment, about 31% from the four-wheeler segment, and about 9% from the three-wheeler segment. As per the entity, which is Indian and the European entity, India accounts for close to 73% of the revenue and Europe accounts for 28%. But still 28% is substantial. Building a business outside the country in a new territory and getting 28% of the entire business is not easy, which is much to be appreciated by the company. Now let's talk about the industry in which this company operates. The auto ancillary industry is expected to reach a size of about $200 billion by FY26. And there are some broad trends which are observed in this industry, like the semiconductor shortages, wherein the companies are facing the supply side issues and they are not able to fulfill the requirements of their end customers. There's inflation in the industries which is increasing the raw material prices, which is creating a lot of pressure on the margins of these industries. The oil prices are increasing, which is leading to increase in the transportation cost, and they also in a way are affecting the demand in the auto sector. There are supply side disruptions like the availability of containers and other supply side disruptions which are disturbing the business of these kind of companies. Electric vehicles is another theme which is very important in this sector, as most of the auto components industry are now even catering to the equipments which are required for the electric vehicles, as well as this company is doing so. Another good trend from India point of view is because of the China Plus One strategy, the global OEMs are now looking at suppliers other than China, which gives them another option to look at India. And the auto ancillary suppliers from India are getting a chance to work with global OEMs more effectively now. The auto components which we were importing earlier are now being substituted by products which are manufactured in India itself. And the government is also promoting the ancillary industries which are manufacturing in India through various schemes like the PLI schemes. The BS6 transition is happening, so all the components have to be manufactured which are compliant with these standards. And the Indian companies are either developing their own technology or they are also collaborating with the companies which are abroad and working as a technical collaboration and manufacturing the products in India with their collaboration. Autonomous vehicles is another theme which is playing in the auto industry, where if not totally but at least partially automated driving has come into place. And other than the traditional ways of sales, now e-commerce and other digital channels are taking up place where people are trying to buy their auto components online as well. So these are the broad trends which this industry is observing in the present times. Now let's understand how this company has an edge when compared to its competitors, or what we call is the economic moat. This company is a tech-oriented company. They are not just manufacturers or having a manufacturing facility making components using technologies from other suppliers. So they have their own R&D facility. They have about 20 patents registered in their name. They have more than 17 design patents registered. They have 200 plus people working in their R&D team. So even if they have to develop a new product or make some product more advanced, they have a in-house R&D team with them. Then they provide end-to-end solution, as we discussed, to their customers, right from the design to aftermarket sales. And they have a diverse set of products categorized into 4 categories we have discussed. So they don't have single dependency on a single product. They have state-of-the-art manufacturing facilities in India as well as Europe to cater to Indian as well as customers abroad. And the quality of products which they manufacture is top of the notch, because they have been working with most popular OEMs across the globe since many years. They have their manufacturing units which are strategically located near the OEMs factories, and they have market leadership in the aluminum die casting business and the other businesses also. They are one of the top 2 suppliers for the OEMs. As you can see, they are the largest auto ancillary player in the 2-wheelers and 3-wheelers segment in India. In aluminum die casting, they are the largest in India. They are among the top 2 players in all the products which they cater to, and they are the tier 1 suppliers to all the major OEMs in India as well as abroad. So this gives them a lot of edge when compared to its competitors. What is the growth outlook which the company is been giving? And this also incorporates a few points which are discussed in the recent earnings call by the management. They recently decided to acquire a company called Maxwell, which is into the EV space. They manufacture the battery management systems. So by this key acquisition, which is again a wholly owned subsidiary the company has to become, the company is venturing into the EV space more aggressively, and this step is expected to generate a lot of business for the company. They will focus more on expansion of the Europe business going further, and they'll focus more on the R&D to add new products to their portfolio. Focus on adding more high margin products so that their EBITDA margins improve over a period of time. They are doing capex across their different manufacturing plants, and they're also focusing on their aftermarket sales business, as this is a higher margin business. As you can see, throughout the journey, the company has been doing inorganic acquisitions, and they will continue to do so, and they have recently done the Maxwell acquisition, and they are also open to alliances for technology with other companies abroad. So this is the growth strategy of the company going forward. Now, what are the risks the company might face going further? The industry is a kind of cyclical, or there are a lot of macro factors affecting the auto industry. So these kind of factors affect this business of this company. The geopolitical issues like the Russia-Ukraine war will also affect the business of the company. If there is another COVID wave, the business of the company can be drastically affected. Inflation is creating a lot of pressure on the margins of the business, and the company generally works with a limited OEM. So there could be concentration of customers, and if at all the relationship with one of the customers gets spoiled, their business might be drastically affected. There is tough competition in this space, as well as there are a lot of players in India and abroad which are competing against each other in terms of quality as well as technology, and the company has to keep the technology up to date as per the latest standards, otherwise it will become obsolete and the company might go out of business. So these are the risks which the company has to face. Now let's talk about the numbers after discussing the business as a whole. Starting with the revenue, in the last 5 years, the revenue is almost stagnant. You see that the highest revenue they have achieved is somewhere around 7,500 crores, and the revenue is kind of flattish in the last 5 years. The similar trend is observed in the EBITDA also. They did about 1129 crores of EBITDA in FY19, but after that the EBITDA has been declining. They did about 965 crores of EBITDA in FY22. EBITDA margin has been stagnant. It's been about 15 to 16%, but recently, due to the inflation, the EBITDA margin has further fallen to 13%. The profit after tax is again on the sideways. It went up to 566 crores in FY20, then fell back to 461 crores in FY22. The profit after tax margin is also kind of flattish. In fact, the inflation has shown its impact on the profit after tax margin also, and it is reduced to 6.1% from 7.9% in FY21. Now coming to the balance sheet items, the equity is consistent at 141 crores. The reserves are steadily growing as the company is consistently making profits, and they have reserves of about 3,779 crores on the balance sheet as on March 31st FY22. The debt is reducing and the debt equity ratio is just about 0.11. So it is a very good sign that the debt is completely under control. They just have about 430 crores of debt on the balance sheet. The trade payables are in normal trend. There is no abnormal movement in trade payables. The fixed assets are steadily growing as the company is doing capex every year, and they have about 2,700 crores of assets on the balance sheet. The inventory is going up in line with the sales of the company. The inventory days are slightly increased from about 40 to 50 days to now 58 to 65 days. So if the similar trend continues and the inventory days increase, it could be a concern to us. The trade receivables are again flattish. There is no abnormal movements. As you can see, the debtor days are also under control. They have about 47 days in FY22. The company has about 400 crores of cash on the balance sheet. And the operating cash flows have also been positive throughout the last 5 years, and they did an operating cash flow about 742 crores in FY22. Free cash flows have also been positive in the last 5 years, and they generated about 200 crores of free cash flow in FY22. So liquidity wise, the company is doing pretty well. The ROCE is declining. Earlier, the company used to do an ROCE about 23 to 25%, but it has gradually reduced to 15% in FY22. So this has to be keenly watched, that the ROCE has to be further improved along with the margins, and the company comes back to their normal margins and a normal ROCE in the near future. Now let's discuss the shareholding pattern. The promoters hold about 75% share in the company, which is very good. The DIIs hold about 16%, FII is about 7%. So there is nothing much left for the public, which is just about 2% in the company. So the shareholding pattern is pretty strong and there is no pledge. A few other financial highlights: the ROE is about 13%, dividend yield is 0.47, so it's a dividend paying company. The stat auditors is one of the big four, which is SRBC and company, and there are no risky related party transactions in the company, and the remuneration to the executive directors in FY21 was about 10 crores, which is well within the company's Act's limit, as well as the amount looks reasonable. Now let's compare the company to few of its competitors and also discuss the valuations part. So Endurance Technology has a revenue of about 7,500 crores, Sundaram Clayton about 25,000 crores, Minda Industries about 8,000 crores, and Craftsman Automation about 2,000. So in auto ancillary, we cannot do a like-to-like comparison, as the companies are manufacturing different products and the companies are of different size, and the technology of some companies is in-house and some companies is outsourced, or they are having joint ventures. So it is difficult to have a like-to-like comparison with its peers. But on a broad basis, you can understand that the Endurance Technologies does a margin of about 13% in EBITDA terms, ROC 15%, and trading at a PE about 37 and market cap to sales 2.4x. Compared to the others like Sundaram Clayton, they are doing an EBITDA of 12%, ROC 12%, which is similar to Endurance, and the PE is just 17 and the market cap to sales is 0.3x. So if you compare with companies like this, you will feel that Endurance is much overvalued, but there are some other peculiar strengths which Endurance has. That is why the market is giving it such high valuation. Minda Industries, the EBITDA is just about 11%, ROC 14%, and trade just a PE of 72 and market cap to 3x. Now in this case, you will understand that it appears to be cheaper with the other auto ancillary. Craftsman Automation does an EBITDA of 24%, ROC of 18%, PE of 29 and market cap to sales of 2x. So this company has better margins and better return ratios and still trades at a PE of just 29. So we cannot do a like-to-like comparison, but still on a broad basis, just to understand how the industry operates, I am showing this comparison. Now let us compare Endurance with its own performance over the last few years. The median PE in the last 5 years is about 37. So it is presently trading at the median PE itself. In terms of price to book ratio, it is trading at 4.6x, and it's a face value 10 share. In terms of valuation, I totally understand that the company is being given higher valuation because of the inherent strengths which the company has, because of the market leadership, because of the technology which the company has. But looking at the growth which the company has delivered in the last few years, which is almost negligible, the present valuations which the company is getting seems to be overvalued. These kind of valuations are only justified if the company in the next 2 to 3 years delivers growth of about 15 to 20% in the top line and the bottom line. If that kind of growth doesn't come, then there is a possibility or a risk that the re-rating happens downwards. It's important to buy these kind of stocks at a reasonable valuation and keep a sufficient margin of safety, or at least keep some stop loss when you enter in this kind of companies. Now let's look at the chart. The chart is not also a steadily increasing chart. It is kind of a cyclical chart, you can see. And in the recent correction, the stock has come up to somewhere around 1050 levels, and it has made a recent high of about nearly 2000. So buying Endurance at somewhere near the 1100 mark only gives me comfort, as the company is not delivering in terms of growth. In the earnings call also, the management is not giving growth outlook in terms of numbers, as they say that there is a lot of uncertainty in the sector in which they operate. So keeping all these things in mind, it is important that these kind of stocks are better to be bought at the lower levels. So this is about Endurance Technologies. To summarize, let's discuss the thesis and antithesis points. In terms of technology, it's a tech-oriented company. They have in-house R&D team. They are market leaders in whatever products they manufacture. They offer end-to-end solutions to their customers, right from design till aftermarket sales. They have worked with the biggest OEMs across the world, and they are continuously growing organically as well as acquiring companies in India as well as abroad. So these kind of things will gives up a thumbs up for investing in the company. We have to also keep factors in mind, like this is a cyclical industry which depends a lot of macro factors and geopolitical issues. Returns from the auto ancillary space may not be consistent over a period of time. The growth in the company has not been so impressive. These kind of auto ancillary companies have a lot of dependency on the business of the OEMs. If the OEM's business is doing well, these kind of companies do well, or vice versa. And their dependency is on selected OEMs, and if there is any relation which gets spoiled, they lose a lot of business. And in terms of valuation, looking at the growth rate, I feel that the valuations are slightly stretched. What do we mean when we say the valuations are stretched? Will the share price not go up? The share price can go up even if the valuations are stretched, but investing at the current valuations, we are not getting the margin of safety or the comfort in investing in this kind of companies. So that's about Endurance Technologies. I hope you like the analysis and you are able to take the right decision to invest in the company. If you're new to the channel, please do subscribe and hit the like button before you go. And if you like the video, share it with your friends. Don't forget to join our Telegram channel. Thank you for watching and have a wonderful day.